Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Wednesday, September 11th, 2024. We're going to do a quick update on the markets, any trade ideas that need updating, just kind of what I'm watching, what I'm seeing out there right now. All right, starting out here, the NQ, boy, it just wants to keep running and running and running at this level here. I'm going to zoom in a little bit for you. Well, I'll zoom out first, just kind of give you the bigger picture if you're catching up. So here's our recent highs, divergent high, multiple sell signals, both here on the 60-minute chart as well as the daily chart. We ran down, milked that move down. That was the August 5th lows, rallied up here, and it ended with that divergent high, which most recently ended with this divergent low. Now, in the last few days, if you've been following, after that divergent low, we gave you a couple potential targets and resistance levels. First being this downtrend line, which we hit, and I'm talking off this divergent low, and then this key support zone right here, the support level, which we had that brief undercut. So we broke back above it, making this so far a whipsaw right there. Rallied up, hit the trend line as expected, and the first resistance level on price right there. Pulled back tested the zone successfully. After testing the downtrend line, broke out, and then it's all been about this level here. Now I'm going to have to probably move the line up a little bit, but I've had it at about 18,827. I mean, you've seen this chart a half dozen times in the last few days. And that's it. We just continue to bang on that level. And what happened today is, and this is why in that post I got out to you this morning, I was very clear to say, on the bottom of that, hey, also keep an eye on the financials and keep an eye on the yen. The financials being the biggest, because as I said, the S&P 500 has been until recently doing quite a bit better than the tech-heavy Nasdaq 100, and that was the bulls probably the most solid leg they had to stand on, saying, "Oh, this is fine, tech wreck." Just a correction in overpriced tech and this healthy rotation. Financials are at all-time highs. Well, then, as predicted, the financials broke down, and the S&P, and that's what happened today. So we were here this morning. We had another pop at it intraday. And remember, that I also made it very clear to get out this morning. It was in pre-market, and so here, if you look what happened in the in the regular session. Here, this is, I'm going to put my crosshairs at 9:30 a.m., or I'll just draw it for you right there. And so this is why I was very clear to say, hey, that breakout has to stick, this breakout right here in the pre-market, in the regular session, because this is the amateurs. These are the bench warmers. There are pros trading in that session, but liquidity comes into the market when the opening bell rings at 9:30 and all the players, including the starters, step onto the field. So this is like preseason football right here, and then this is the regular season games between 9:30 and 4 p.m. And what happened? They sold the heck out of it, okay? And they immediately sold it. So that's why I said that breakout had to stick in the regular session. Now, we still have a chance. We're there again, and this is boy, this market is just running up now. Obviously, it should go without saying if we can't take that level out. And now we've had a couple punches through there, but again, nothing on a solid 60-minute close and nothing in the regular session. But it's a little higher right now. We need it because we've had a few runs at it. So that's what we need to do to clearly run up there. This whole thing that happened after the market opened was 110% due to the financials. And that's why I was very clear in that post this morning, watch the financials. The tech isn't going anywhere if the financials break down. Tech is the largest sector by far in the NASDAQ. There are virtually hardly any financials in the NASDAQ 100. It's basically a financialist index. It's all mostly tech, biotech, high growth stuff. But the same components in the NASDAQ 100, the top components are also the top components in the S&P 500, which does have a pretty heavy weighting in financials. And again, financials, if nothing else, are every bit, if not more important, I think most could argue, to the U.S. economy than the tech sector. Tech is the most important thing to the stock market because of its heavy weighting with those mega cap multi-trillion-dollar companies, or multi-billion and trillion, a few select handful of trillion-dollar companies being tech. But yet the banking system is the greases the wheels of the U.S. economy. So I think we can all agree on that. And so that's what happened. That's why, if nothing else, the takeaways you're learning from the site, things I've learned over the years, is if you are trading in a vacuum, you're trying to trade the NASDAQ 100, you're trying to trade the small caps, you're trying to trade the S&P, and you're not watching everything. Not everything, because again, it doesn't matter what the cannabis stocks do today or what the utilities do. Cannabis isn't a sector in the S&P, but utilities are, but they're the lowest, or one of the lowest, third lowest sector. They don't move the needle. So you want to watch, if you're going to trade the markets, you want to watch the S&P 500, the NASDAQ 100, and then at least the top 3 or 4 sectors in the S&P 500, and that's what I do. And again, financials being the one that stood out recently. And we had a breakdown, too, in healthcare, so it's not like that didn't happen. So that was that, and I'll show it to you here. So when you go to XLF, the financial sector ETF, here's this morning. We pull a 1-minute chart. And there's where they closed yesterday. Remember, above support. This was Friday. We hit my first target there. We had a sell signal on the break of the uptrend line. I've been covering this in recent weeks' videos. Sell signal coming to break the trend line on the daily chart and the 60-minute, which we did. We hit that. We had the bounce as expected on Monday. Came back down, hit it again. One last hurrah. And then we took it out today. And we went straight down. It was like a game of Monopoly. Straight to jail. Do not pass go. Do not collect $200. And figured we might get one last hurrah because there was some little support on the futures of the financial sector, but we didn't. And that's the way these targets work. And I've said this quite often. I say it all the time. The reason I list multiple price targets, where those folks on TV come out and they'll tell you their price target for the S&P. They don't list, because I'll game these bounces, or if you trade them as you want. I provide analysis. You decide how to trade it. But what I say on this, and it's on the site under resources, if you go in there, trade-related questions under FAQ, the FAQs, why do I list multiple targets? And that's because upon the initial tag, each one a reaction is likely. But then once that initial reactions happen, it doesn't mean you can't have other reactions. It doesn't mean that won't be the final reaction. It just says it clears the way and significantly increases the odds the next time around you're going to break it, at least, maybe one last hurrah. And that's what happened. And then look, this is, these targets were laid out, well before we got here. The low today was 48.38 against my target of 48.39. I think that'd be considered close enough for government work. So we hit that level, and that's where the sell-off stopped today. It's a level I have confidence will go. That's why I list multiple targets. I think the final target, and these are, by the way, guys, near-term swing targets. This is, once again, a 60-minute chart. The daily and even weekly charts have my longer-term targets for financials for the market. This is just where I think we're going in the coming weeks. But the coming months, longer term, then we turn our focus to the daily chart. So at some point, I do expect T4 to go. Just as of now, the way this happens, reaction there, which we've already had both of. And then once T3 goes, T2, you got a little gap right there. But when that clearly goes, let's say you bounce up here. Let me show you. Hold on. I think I got it. Yeah, I got one out to you today. There's a potential. There is a downtrend. It's not potential. It's got plenty of reactions to validate it. Uptrend line. So you're the way this works now. Support once broken, which is T1 at about 44.14. Support once broken becomes resistance. It's very simple. And you also have a downtrend line, which is resistance. And based on the scope of the pattern, the fact I list multiple targets, I suspect these targets will be hit. Or I would tell you right now, I'd close them out and say, let's cover here and go long. And hey, that may happen, guys. If you made the quick buck, I know at least one of you yesterday told me you were in FAS. It worked out good for you. I told there was a subscriber I mentioned. I took SKF, just figuring we could grind around until the big tech breaks down. I'm going to get to that in a second. And then we still could now. We hit that second target, but a lot of financials are breaking down. And we're clearly on sell signals. And they broke down on the daily charts. Remember, this is a little 60-minute chart, go-to swing trading time frame. But the breakdowns in the initial video, when I was covering it in the video, I was covering all the daily charts of the financials. And so this is just kind of an X-ray view or a zoomed-in view of that same trend line on the daily. Okay, so that's it. So bounce, targets, potential, that's first resistance, second resistance. And so that's kind of what I can see. And look, I'm not sold on this at all. We're getting to the point. I'm going to talk a little bit about that. I've been talking about that recently. In addition to giving you multiple targets as to, levels that where I think reactions are likely on trades. What I also do, to the best of my abilities, and when I have pretty strong convictions, is share how I think it's going to play out. And I use that little map feature. Like you walk into a shopping mall or you're at a theme park, Disney World, and there's that, you walk up, you don't know where you are, and there's a map. It says you are here, and there's the whole, shopping mall or this. And so I think we're at the point in the stock market. Let me just loop over to that, and then we'll go to QQQ. That's been my proxy here. QQQ, weekly chart. And again, this might be a recap for many of you. Some might be new to the site. This is my market top range that was laid out before we even got there. We topped in the market top range, and these are my 7 targets. So the where we are is how I think this thing's going to play out, and that is with an initial wave down, which we covered with impunity at the lows, followed by a counter trend bounce. We gained, at least I did part of that, the first half of that, scaled in on the second half to get back short, and this is where I think we are. And so what I've been trying to do is pick up a few nickels in front of a steamroller. I still think there's a possibility of that, but we have to break those resistance. We have to take out that level on NQ and QQQ. I'm going to get to tech in a second. And financials have to hold here and not melt down. That's a big thing too. So a bounce here, that's the same, that downtrend line right there on QQQ is the same as the potential bounce targets. This is, I know, is a busy, what I call a busy chart, a lot of lines, but you have a downtrend line off the highs in QQQ and then a little minor downtrend line. So the primary and minor, and those are pretty much your bounce targets if we get a counter trend bounce before the next leg down. But based on that whole mapping system of where I think we are, my degree of confidence that we're going to not only go to my deeper, very, I don't consider aggressive. I know a lot of you consider my 50% drop in the NASDAQ aggressive. Not only has my confidence gone up with the financials and healthcare sectors now, those are the second and third largest sectors in the S&P, right behind the top sector, tech. With those breaking down recently, it increases the odds that we're going to get there. And it also increases the odds that this counter trend bounce, that's already thought it ran its score. I told you before, that's where I would have stopped out if we didn't went any higher, because I've been mapping the thing out in my head how it should play out if it's going to play out. And so far it's playing out that way. And that still, it holds to be the case. If we go up much more than that, hey, maybe something else is going on, and the NASDAQ 100 is probably going to want to make a run at new highs. And when does that start to increase? Well, obviously up there. That's what I was saying back here on this rally up. But, if we take out this uppermost bounce target. So that's where I think there's decent coin, better than coin toss, or I wouldn't be trying to, game it right now. A little better than coin toss odds, but I'm not married to it. Not at all, because where we're at in that whole mapping system, again, when you go back to the kind of where this thing might be in the whole cycle, is that if I'm right, we're not going to be here very long. We're going to start to go down and then quite likely waterfall. However, you can't position for that yet. I don't think so. Not aggressively short, because you might. Hold on, let me take that back. Absolutely, you can. If you're a swinger trend trader, and I've talked about that all, all I'm looking for right now from the recent lows or from where we're at today, if we pop above, now you can see, look, this is even clearer for you. 460, and that's a level I've had here on this chart. 460 is now the resistance level. Before it was here, the first one was at 458.78. I had 460 there. That was created back on June 18th, so it's not like I just added that line there. It's been there, unless I tweaked it on the 28th June, you can see on the pop-up box. So it's been a resistance level for a while, and it still is. And this was the first one. We popped that one, we ran into the next one. So when they're in close proximity to resistance levels, it's what I call a resistance zone. So now we pop that, we go up here, most likely hit that trend line. You can, most likely get a pullback if you're an active trader. You want to try to game that, or if you want to sit tight and not risk getting shaken out, you can try to hold out for a bigger move up. So I want to measure it for you. And again, I'm speaking now to the longer term trend trader. That's only 3.5% from where we're at right now. Now, of course, there's a thing I could be wrong. We pop above there, we keep going up. So you've got to have your stop somewhere. But if you look at it logically, then you give 3.5. You're going to give yourself a little bit of room above it, just in case they want to do a little stop clearing pop above the. Let me make it nice and clear so you can see that trend line. We'll color it up blue, and we'll make it nice and thick. All right, there it is. So that's where a longer term swinger trend trader, because I know some of you listen to my voice, your head is spinning right now. Even me in the last couple of days, I told you my active trading account, I've reversed long, short twice since Friday. Short, long, and still sticking with that now, and ready. I keep telling you, ready to flip on short notice back. And what we need to do, let me show you where I think this thing has run its course, the bounce, whether it's right here or all the way up here or anywhere in between. I'll say with a pretty good degree of confidence, going back to these 60-minute charts, when we take out the recent low. Remember, this is NQ. There's our lows from last week. I think it was Friday, right? If I remember right. We take that out. And to be honest with you, it's probably going to be here. This was the support level that I was focused on, that zone right there. And that was a little whipsaw. We took it out. We successfully back tested the bottom of it on that first pullback. I think you can see it here. Right? Successfully tested the bottom of my support zone there. And then a couple tests of the top, including today, and that's all that was. But again, the financials are breaking down. To me, those breakdowns, even the setups, were glaringly obvious, and they were obvious enough to even get short before it even broke down, because it was so clear, those bearish chart patterns. But what I'm getting at is, they're very well, it's not the charts are not obscure or muddy to me. They're pretty clear. And I have to imagine they're clear to some of these, fund managers, let's just say, as well as retail traders that might be pretty heavy in bank stocks right now. So I think it's just the start of that. So how far the NASDAQ can carry up here is going to depend on when the next wave of selling comes in the financials and when they take out today's lows, which again, going back to where I just covered XLF, that was support. We hit support to the button. I was within 1 penny on that. And so you're talking a mere basis points, a small fraction of 1%. And so that was support. They bought it there. They're bouncing it right now. How far they go will determine how far the NASDAQ goes, because these tech stocks, some of them look good right now. NVIDIA, like I said, if you want to just watch one stock, I highlighted this as a trade idea here with a bullish falling wedge off trendline support, broke out. Off this is where it hit the trend line, and you're already up 12% off that divergent low. Remember, this was another test of the trend line, same exact place. Covered it, went long right there. I told you I'm waiting to get back short into the stock. It's just not the time yet. I can't make a case to start shorting NVIDIA again. I can only make a case, like I told you the other day. You can only make a case, to go long on a pullback to not just support. There's support out there, and me, I like to gauge support on a scale 1 to 5 or 1 to 10. This is close to a 5 on a scale 1 to 5. This is, like I said, it doesn't take an expert technician to see this uptrend line in NVIDIA. And the fact that it had 1, 2, 3, 4, 5, almost pretty much at today's low, 6 days testing that level, and now it's starting to move off it. That further validates it. Remember, I had this trend line here before we even got to it here. There was the target. It was the price target from all the way back when I gave you the targets for the market tops back in late June. So that helps what I'm getting at, guys. I'm not tooting my horn. I'm just telling you that the fact we had two additional clean and distinct reactions, or multiple. I consider really this one. This is a cluster. So the way I look at it, that's 1, 2, 3, and then these 4, 5 right there. Okay. And again, it's a level I think will go. It could go tomorrow, next week, or 3 weeks from now, max. Ideally, again, to keep the bearish case alive and well, you don't want to see it exceed that uptrend line. That's the last place I highlighted as an objective short, was on the back test of that trend line. We got that. And again, let's cover it there, wait, and we'll wait, and the time will be right. Well, again, whether it's today, tomorrow, or a month from now, if this trend line goes. And then, boom, this is kind of lights out. That 96.23, you got the 200-day moving averages coming up under there. This is just, and that's going to significantly increase the odds at my longer-term targets, which, again, were laid out in late June with a target all the way down here. Current, remember, potential is just a potential target. If I eliminate the word potential, it's an official target. Right now, T4 is my current final target, and that's calling for a 77% drop off the highs, which I think is pretty aggressive. So we'll see. So far, we hit my first target, and we bounced. That's it. And the way it works is when that first target goes, just like the target on XLF that was hit today, that opens the door to move down to the next target here, T2 at about 76, and T3, so forth and so on. All right, I think you get the point. We're, poised again. You look at, I know a lot of you don't trade futures. I covered because that's what I trade in. I think there's more levels. Look at how many more reactions. Remember, I started the video out. We were looking at a 60-minute chart NQ, and you had multiple rallies up to this level, because a lot of them, including today when I got that chart out to you, occurred in pre-market session. You don't see that here in QQQ. So I always say, looking at the NQs and ES, the futures, it's like having X-ray vision, or if you're a fisherman or a boater, having polarized glasses. You got the guy or gal on the boat next to you that doesn't have polarized glasses. They can't look down and see the fish on a sunny day where there's a lot of glare on the water. Polarized glasses will cut right through that glare. You can see the fish or the rocks on the bottom you're about to hit on the boat if you're not paying attention. And that's kind of what the futures will give you, is all the additional levels that are important to watch. I just want to make that clear. So I know a lot of you want just ETFs. So 460 is the magic number now. 460 pop, come up here. You're looking today if it happens, which if it's going to happen, we keep punching it. I thought it would happen yesterday possibly, and it didn't. But here we go. Today, be about a 1% lift. So we'll close the day about, just to that target, that is. We'll be up about 1.3% at the time. That's going to be that initial downtrend line. You got price resistance there. And on NQ, I only have that other trend line. Let me measure it to that one. 2, that's the larger uptrend line. And price resistance, that's about a 2.5% lift, again, from where we're at right now. Let's see. Let's go to. I already covered NVIDIA, Broadcom. Like I said, started highlighting this one leading up to earnings, calling it down from earnings based on the technical postures, which certainly we got. Big dropped over 10%. But then said, look, I acknowledge it, took out the trend line just like it did there on one daily basis, but it hit the 200-day moving averages, whereas I think it's hopefully a takeaway if you're new to trading, investing, you've learned, especially after big drops, thing about the 200s, they're going to go eventually, and I think they'll go sooner than later. These are the last few hurrahs on them, I believe. But again, as bearish as you want to be, as much as you want to short, if a stock has come down, like from when it first dropped there and it was down 32%, that's when you want to be buying, not selling a stock. And same thing the other day. And so And oh, look at that. What did I tell you the other day? We hit that level. I said objective long with a target that probably backfill the gap. So if you took it, you made 11%. There's a gap backfill and the downtrend line. So in my opinion, downtrend line's a hair above. Time to either tighten stops if you want to let it ride for a potential run or trade, or just take your profits. Take your 11% and run. Why not? But again, you want to milk it out, see if you can get a little bit more. Here's a 60-minute chart. If you take the downtrend line that way, it might run up there. There's officially the top of the gap. It's a little bit higher, so there's a little more room. But remember, guys, the thing about trading, all eyes see this gap. That was a target I laid out for you a few days ago. I'm not the only one that sees it. I give you my word on that. A lot of traders see that gap. And now we can blast on through it. Sometimes that happens, but odds favor they're going to sell it. And why set your limit order at 152.93 or the bottom of that candle? We'll call it about 153. That's technically where we closed right there. Why set your order there and try to milk out 1.3? If you set it a little below, that's what I like to do. Is it worth risking an extra? You've made 12% or whatever, trying to get another 0.25% out of the trade and risk a sudden reversal? Because if one thing this market does when volatility is high, like it is lately, it's been increasing. When the sellers step in, they can step in fast. So I just wanted to point that out. So there's a Broadcom coming up on that bounce target right now. And then sometimes if you are, and I know, I don't hear from them much anymore. Every time the market drops, they go away. And then when it bounces a couple of days, the trolls come back. But the that disregard all the reversals, all the long trade ideas, just focus on any shorting. But lately they haven't had much to say about that. But where I'm going, bull or bear, troll or not troll, if you're longer term bullish, what I'll do in these situations, if I think there's a good chance we're going to break it, I'll just ratchet stops as it starts to go up. You got to give it a little bit of room, because just the daily grinds will stop you out. How much room, you just have to kind of gauge it and look at how volatile is the stock, how choppy is it day to day. And then by periodically raising your stops, you're giving yourself the potential for a lot more upside. Again, I wouldn't try to milk too much out of this one, but I can tell you it hit the 200-day moving averages. The last time it hit them, the stock went up 32%. The time before that, it hit the 200-day moving averages. Before all is said and done, the stock went up 117%. Okay, so you figure out how you want to trade it, where you think the market's going. Remember, what I do, what you're paying me for is analysis. I give you the key levels, objective entries, key levels, meaning resistance levels that long side traders can use as price targets to take profits on, and short sellers can use as entry points to short rallies into resistance during a downtrend. And that's kind of the way I'm in that mode right now, game these active trades. All right, let's move away from that. You have the levels to watch. You have the levels on the S&P 500 as well. I think I gave you that. I gave you those recently. You can see SPY keeps pushing up here around 54.87. And as I told you recently, when the financials break down, which they did, you'll start to see that gap closing, where recently it was the NASDAQ 100 was vastly outperforming to the downside the S&P 500, and now we're seeing the S&P 500 outperform. Why? Because, again, the weighting in the financial stocks. Okay, other trade ideas for you. Let's talk natural gas. This is a 120-minute chart of the futures NG. 120-minute means every candlestick's 2 hours instead of 1 hour, like my 60-minute charts. That was a divergent low. We gained a rally there. Divergent high with a sell signal there. Gave us this divergent low. Went long off the divergent low. That was a price target on the previous futures contract. Remember, these roll, and so every time they roll, I have to mock up new levels. The levels change. And so that was a price target, and it was a divergent high too that was hit, and then sent us down virtually equal lows on the indicators, with higher lows on equal lows on price, higher lows on the indicator. It comes all the way here, as well as the smaller divergence. We had divergence there and even bigger divergence because you had the higher lows all across there. And so it's really one and the same trade if you want to look at it that way, if you're a longer term trader with the longer term targets I laid out, or you know, active traders would have sold that target divergent high, gain back in here. And so I just wanted to point out we have this looks like a potential symmetrical triangle pattern right here, and you can see a lot of what I call micro resistance levels, really a resistance zone, and the top of which is about 239 right here. So if we can just pop this, it was key support back here, and we'll also pop the triangle, and that should open the door. That's about 246, 262, 285, and then $3 potential targets there. Crude oil I want to show you too. Okay, crude oil, you've got this, this is a 60-minute chart. Yep, 3 months of price history. You've got a nice, well-defined downtrend line, positive divergence. I mentioned that the other day. It's been building divergence, but now this trend line is starting to firm up. So this looks like an objective long on a pop above that trend line. Pretty much over today's highs, should do the trick, the recent highs. And I'll give you targets for you futures traders, and I'll try to look at USO for you. First target is going to be here about 68, 86. That's about a 2% pop. And, you know, I wouldn't get married to crude. I think we're heading into recession. You're going to see demand destruction. Second target there, 71.50. Let's just, for now, see if we can get that. And, you know, that'd be about a 6% pop right there. For you ETN traders, USO, bullish falling wedge right there. Breakout would bring you up to about 69.50. And then that second target's going to come in right here at about, let's just put it here, let's be safe, put it down here about 71.55. Those are actual resistance levels. You always want to sell just shy of the one you're targeting, whatever your preferred target is. Positive divergence also here on the 60-minute chart as well of crude futures. So that would be, let's see if that meshes. Yep, about close to 5% lift to that second target. Wheat and the grain still looking good. They're not screaming, but this is wheat. It still needs to pop that. Remember, this T1, that's a big level. We've been flirting here with it. You want to clearly just pretty much needs to pop that recent high at about 522, and it should open the door to the next targets. And then, you know, the grains tend to move together, so it's an overlapping trade, but it's a way to diversify. There's corn. Corn has this downtrend line right here. It needs to pop, and the 1819 level. I'm going to pull this line down right now to right here. 1850 would be your next resistance, and then it should run if it can take that out. And then soybeans, it's your other grain, divergent low right here. You need to borrow one of these. Borrow you. Duplicate. Nope, that was the line. Didn't need to do that. Meant to borrow this annotation, put it there. You can see that was a divergent low. Rallying, took out the trend line. These are still potential price targets from before we hit that T1 right here, or I can't remember now. Let's just retask them. Let's say I'll tell you that's T1, T2, T3, T4, and so forth and so on. And yesterday, I think I told you I'm starting to get ready to short treasury bonds. This is TLT, the 60-minute chart. Negative divergence right here. With a now, one thing I was lacking was any type of well-defined uptrend line or support level in which to trigger a sell signal. So I'm going to put a level here too. We have a distinct reaction high right here. And we come across, what's the trend line should do the trick. Targets aren't clear right now, but I can tell you we have divergence all the way out here. This is a little bit of a messy chart, but there's divergence. We're also right at this previous reaction high. Remember, TLT is a 30-year bond ETF. It holds 20 to 30-year treasuries, targeting 20 plus year, targeting the 30-year bond. They just can't continually hold a 30-year bond, because every day is 1 day less to maturity. So they keep rolling in. That's why it says 20 plus year. previous reaction high, so that's going to be a significant level in interest rates, and yeah, swing it down. So I think it is time if you want to wait for a break of that trend line there. Futures, I'll show you. There you go. Look at a big old, this is a 60-minute chart. That new high is a marginal new high, so that's what's changed since yesterday. And you have a nice clean uptrend line now, which should trigger an objective short entry. We're just above it now, so maybe by the time I finish this video, or today or tomorrow, there's your sell signal. I could give you a target right here. I could tell there'll be a stop around there most likely, but you want to swing it down. Let's just keep it simple. One sold target. It's going to be about a 4.5% drop in treasuries if hit. And just if you're new to the site, something I came up with years ago, and I used to list it on each trade. And if you ask me, I'll give you my 2 cents. I call it beta adjusted position sizing, which means all securities aren't created equal. Beta is something you benchmark it against the S&P 500. S&P 500 has a beta of 1.0. So anything with a beta higher than that goes up and down more. For example, the NASDAQ 100 tends to rally more in a bull trend and fall more in a bear trend. So it has maybe a beta 1.2. If you go to something, and I'm not talking about the correlation beta. That's also used, like in other words, natural gas has low beta. It's not correlated to the S&P 500. I'm talking about the volatility in something. So when I say beta adjusted position size, treasury bonds and it don't move nearly as much as the stock market in percentage terms on a day-to-day basis or during trends. A 3% move is not unusual in the NASDAQ 100, S&P 500, but it is very unusual in treasury bonds. So 1% is a pretty big up or down day. So therefore, I always say when I trade treasuries, if you were to use TLT or IEF, the 10-year, then typically I would say do a beta adjusted size of 2.0 or better, meaning twice what you might normally put in the S&P 500, because your losses are going to be smaller in percentage terms if stopped out, because your price targets are smaller in percentage terms if hit. And so therefore you can put more capital in. It's all about how much money you make or lose. And of course you can always figure that on right side of the chart. On the website, you either click on resources and it comes down here, tools of the trade, position size calculator, or even easier right there, see that little calculator icon, hit that, and then you're going to be figuring out, like, so I know, let's say your size, because usually you do 10,000 in SPY, that's what you like to trade, and it's but this time around you're going to do treasuries, so it's a 2.0 beta adjusted position size twice. So you put in 20,000, it's going to be a short trade. You put in your entry price there. I'm just going to pick a number, $20, and you're going to target $15. And so, your stop's going to be $22, right? And so it's going to give you a risk reward ratio, how many shares you should buy, percent gain if your target's hit, and I'd use pretty hefty percentage gain there, but you get the point. It'll help you figure out how much to buy, and the most important thing in trading is how much money you're going to make or lose in dollars. Percentage is irrelevant, really. It's relative to what you're trading. Natural gas, for example, beta adjust it down. You usually put 10 in the S&P 500, and you're going to trade UNG, or then you're going to have to temper that down because there it is, 10,000, whatever it is. I have to clear it out. You're going to take that down to maybe even a half a position size, because natural gas is much more volatile. And again, you can figure out here, and that'll help put in your head. And then, when you have that in your head, how much am I going to lose if I'm stopped out, and how much am I going to make? It just helps with those. If you're new to trading, because from my experience, what happens is most people don't figure out. They just see the dollar signs if right, and when things start going against them, they second guess why they're in the trade, and they tend to pull the plug early. The other thing too is diversification. I do these long-winded videos, and I cover a lot of different things, because natural gas or crude oil. Crude has some correlation in the stock market, only because if crude prices get really high, then it starts to matter. Other than that, the correlation's not really there when it's in a normal range. But in natural gas and wheat has nothing to do with the S&P 500. So these are diversification trades, if nothing else, and they're also pure play trade ideas. Bonds that tend to have a correlation with the stock market on and off. But I'll tell you, the Fed's flipped everything on its head. The old mechanism of what we call price discovery in the financial markets was just outright taken out, back, and shot by the Fed with market manipulation, excessive intervention, easy money policies, quantitative easing. And so you kind of just have to go, in other words, each trade, you have to use it on its own technicals. We know that the whole 60-40 stock bond model blew up back a couple of years ago when Fed started hiking rates, and they had bonds suppressed artificially low rates. And stock market took it on a chin, but the bonds had nowhere to go in price but down because yields had nowhere to go but up. All right, I'm getting ahead of myself here, but this is important stuff. Like I said, I'm speaking to those that have been trading for a while and those that are new to trading. Just keep your position sizes in line with the risk for each trade. So there's your trade idea on TLT. You could use the 10-year bond, but I always say, you're either going to be right or wrong on the call. TLT, the 30-year bond just goes up and down more in price in percentage terms when rates go up or down than the 10-year. 10-year is just less volatile because it has a shorter duration. All right. I think I'll wrap it up. Look, we're right where we started. Here's the NASDAQ wants so badly to try to punch through that level, but the buyers just aren't coming in yet. And if they can get up there, maybe they can. But again, this is what you got to watch right now. It's these financials. They did step in and buy it off T2, not very aggressively. And, if I were to go through each and every of the components, like I said, more and more are breaking down. JP Morgan, like I said, was the first to break down. Nobody but us, or few, saw it until about right here. And then when it took out that BOD, or first support level I had at 216.31, big leg down, big drop. Dip buyers did what they do. Those that don't know how to read charts said, "Oh, it's a good buying opportunity." JP Morgan's just biggest pullback in a while, down to the 50-day moving average here. But they didn't realize it broke the uptrend line after a big divergent high, overbought conditions. Then it broke 216.31 support, and it rallied back to that support. And remember, support once broken becomes resistance, and couldn't get through. They tried to get it up there, and then boom. This is, and there was some comments from them, but if you followed me for a while, you've heard me say this once, and one of the things I feel super strong about is the fundamentals and the technicals, these things, and you don't have to understand how or why it works, they're intertwined. Usually it is a technical catalyst first. Sometimes they coincide. In other words, earnings release or a news event release. But these comments from JP Morgan the other day, in the right market conditions, if coming out of a bullish falling wedge pattern after a big huge drop down to support with bullish technicals and everything else, would have either resulted in a rally or a non-event. So we're at the point now where we're starting to see that bad news is finally being recognized as bad news, and it's kind of the trend we're going there. All right, guys, that's it. I'm going to stop it here. I've been talking for a while. The levels, and kind of where we're at. So like I said, I am very cautiously driving with one foot on the gas and one on the brake, ready to reverse. I think there might be a little more bounce to milk. It's not very much. If you're not an active trader or you're risk adverse, you might want to sit back right now or wait for those levels to go. And if you are, have swing short positions, I see nothing right now in the last week or so that has dampened my bearish outlook, my longer-term bearish outlook. In fact, on the contrary, everything, especially the financials and healthcare, the second and third largest sectors finally breaking down, only serve to reinforce it. So, like I said, I just And we might get a little more upside here as the financials hit support today, and we have Nvidia and some of the big techs above trendline support. Not to mention the semis too. Remember, let's not forget pointing out stocks, right, hovering above the primary uptrend line, and that's it. So let me wrap it up here. See what happens today. And all I can tell you is stay flexible, nimble. If you're not sure what to do, nothing wrong with going to cash or keeping things very light. And, watching, learning, paper trading if you're new to this. But there's still plenty of downside. Once we get those big sell signals, I will certainly let you know when. And you have the levels. I don't need to let you know, nor should you wait till I tell you. Have price alerts set. Have price alerts set on stocks right there. Have price alerts set on Nvidia right there for the trend line, and then 96.23 and the 200-day moving averages. Broadcom, XLF, AVGO was supposed to be Broadcom. Broadcom, you want to see it take out the 200s, which basically just needs to take out the low from Monday. XLF, okay, and so forth and so on. You know the levels that need to go. That'll open the door to the next wave of selling. And then at some point, especially if we get anywhere close to those recent lows, that's the point where I think you want to just kind of grip down on those shorts. Once the 200 days get taken out and we start coming down there, I think that's where you'll see that panic selling. And that could come this week, guys, or it could come 3 months, or it could come after the elections. I'd be amazed if this market makes it through the elections without another big drop, but that's just me. All right, guys, this has been Randy Finney with Right Side.